Hi dear traders, investors are keeping a close eye on developments in the Middle East leading to heightened demand for traditional safe haven assets such as gold and the US dollar. The appeal of the dollar was further solidified by remarks from the US Federal Reserve's chairman about intentions to hike interest rates in a bid to curb inflation. Let's delve deeper into these events in our review of the forex and commodities markets with Maria Stardup. In spite of all bullish factors for the greenback, the US dollar index closed last week with a dip of 0.45%, but still stayed above the mark of 106. The prospects for the American economy appear uncertain, particularly against the backdrop of the Fed's desire to continue its rate hiking trajectory. Last week saw unexpected rises in new home sales, retail sales, industrial production, housing construction, and building permits for September. Based on statements from Fed Chair Jerome Powell, the central bank intends to slow down economic growth. The primary goal of the US Federal Reserve is to combat soaring inflation, for which it plans to persist with interest rate hikes. Such intentions have pushed yields of US Treasury bonds up to 5%, their highest level since 2007. Meanwhile, the European currency failed to break above the key level of 1.06 against the US dollar. At the same time, markets finally received the long-awaited positive news regarding the Eurozone's economy. Thus, Germany's business sentiment has finally shown signs of improvement, reaching its highest point of the past 6 months. Moreover, signals from the European Central Bank indicate that it is too early to cut rates, which is certainly a positive factor for the euro. The Bank of England also does not rush to lower its interest rate, given that inflation remains persistently high despite all the previous monetary tightening measures. Meanwhile, the UK is registering a drop in the cost of living, which led to a slump in retail sales volumes. Consequently, the British pound is trading at its 7-month low against the US dollar, hovering around the 1.21 mark. The Japanese yen keeps trading near its lows. The dollar-yen pair continues to test the key resistance level and also the patience of Japanese monetary authorities. Last year, the Bank of Japan began interventions when the pair touched the level of 150 yen per dollar, and as we can see on the charts, the rate has come very close to this figure. Investors seem to favor buying the dollar over the yen due to the stark policy divergence between the two central banks. While the Fed has lifted its rate to 5.50%, the Bank of Japan keeps the rate negative at minus 0.10. Gold traders were among those who reaped significant profits last week. The precious metal climbed by 3%, reaching $1,980 per troy ounce. This rise came as a response to escalating tensions in the Middle East. Notably, the demand for gold remained resilient even amidst the US Treasury bond yields soaring to their 16-year highs. Investors facing geopolitical strains are leaning towards their traditional safe haven assets, gold. The unfolding events in the Middle East have also shifted capital flows in favor of oil traders. The escalation directly impacts the oil-producing region. The data on crude oil reserves in the US consistently indicates that crude stockpiles are shrinking. Meanwhile, China, the world's largest oil importer, is posting macroeconomic figures better than the forecasts. This offers hope and confidence in an economic recovery, signaling a potential surge in energy consumption. At the same time, investors keep in mind the limited oil supply from major producers like Russia and Saudi Arabia. Hence, it's very likely that in the fourth quarter of this year, the market may face an oil shortage. Brent crude oil is trading above $91 per barrel. These are the trends of the last trading week. Do not miss our daily news reports to be always in touch with the latest events. See you!